Peloton plummeting to an all-time low today after announcing CEO Barry McCarthy would be stepping down after just 2 years on the job. The company also posting weaker than expected results for its most recent quarter and announcing a 15% cut in its workforce. Our next guest just lowered his price target on the stock from $7.50 to $6.50 a share. BMO Managing Director Simeon Siegel joins us now here in studio. Simeon, great to see you.
Good to be here.
What are its options?
I think we have to, and it's funny, you and I think had this conversation when Barry started. So I think we were talking about, okay, what's next for Peloton? And we can have the same conversation now. We're just chop off a zero, right? The stock was 38. At the end of the day, giving them all the credit they deserve, this is a business that has 3 million people, 3 million subscribers, actually closer to 6 million people, that are paying $44 a month at a very high margin to use this service. That's a good proposition, but that doesn't mean it's going to grow. And I think in every breath, in every conversation with this company, we have to decide, is there an asset that's under earning and undervalued, or is this a growth vehicle?
The numbers look good, and I'm wondering how engaged these people are, and if there has been a deterioration over time. Automatic renewals for lazy people mean that the numbers can be bloated.
And I'm sure that they are. And so what we did was we chopped off a third of that investor base. So if you take 3 million down to 2 million and assume they get no pricing power on that, and then decide what you want to pay for that multiple, right? We look at, is this a streamer or is it not? You can decide what you want to pay for recurring revenue. You get to the stock right now is effectively underwriting dramatically more concerns because there's debt questions. But if we were just looking at the business and we could internalize and management could internalize that perhaps growth isn't the answer, then you might find an under-earning, undervalued asset. As long as we keep trying to grow, that's where we keep losing money. That's the issues you and I have been talking about for years, where this may not be a growth vehicle, and that can be okay.
Okay, so let's say you cut spending on advertising, you cut a lot of things if you're not trying to grow, and then you have this melting ice cube, and you said, we were talking in the break, churn at about 1.5% per month. Doing some sort of, DCF for however long you think this subscriber base can hang out, what's it worth?
And so that's why hearing that we went from 750 to 650, it kind of sounds a little bit comical. I get that, right? At the end of the day, the question is, are we taking that negative terminal value, but we're saying there is value in that? Are we saying that if 3 million people or 2 million people are paying $44 a month, then we're somewhere above $1 billion in recurring revenue, and that flows through at 65 to 70% gross margin. This is a very healthy, being in your house, jumping on a bike, and paying $44 to do that is a beautifully healthy contribution to the company. The problem is you'd come back and say, well, then why do they keep losing money? And the reason they keep losing money is because, in my opinion, is because they keep trying to grow. They keep pouring all that money back in. R&D is 11%. Sales and marketing is mid-20s.
Wow.
They have a huge office right near here. There's 600 to 900, depending on the year you want to look at, of G&A, and that's what we're seeing happen with these cuts. If we could just focus on, if I told you I have a business that's generating $1.7 billion of recurring revenue, and that's generating over $1 billion of gross profit dollars, you'd say, okay, even if I'm going to handicap that lower, how low do I go? That's worth more than $3 per stock. But if instead I keep taking all that money and trying to chase for members that already bought their bike because we had a pull forward, that's no longer controversial. I used to argue that, and it was controversial. People get the pandemic was a pull forward. Where do we go from there?
Value in the name and the hardware, I happen to think is very good. Is this a bolt-on for somebody or is that not even in the cards anymore?
I guess it's always in the cards, and it's been a conversation where there have been a lot of players that have been talked about. I think we need to remember, if we think about the different companies, and again, this is above my pay grade, so this is just my own musings. Nike, Lulu, Under Armour have entered the equipment space and have all moved back. Lulu was the most recent. We watched that happen. I don't think that's the avenue they want to go in. They make a lot of money selling a lot of shirts and shoes. You look at some of the others, the Apples, the Amazons. Well, Apple looks at this business. The whole appeal was I own the best possible customer for a material part of their day. You asked about engagement. Does Apple do they want the melting ice cube, or do they want something that's up here? And then Amazon's already selling the bikes. So what do they get? So I think that the conversation here feels much more of does someone see value in the asset from a cash perspective? Is this you run for cash and then there's value and it's under earning? I think to want to buy it for that bolt-on, you have to believe in that growth, which again, the company does. They were explicit on the call that they believe there's growth.